and welcome to the latest Retire Well episode with me, Matthew. And as always, I'm joined by Joe. Today, we're going to be talking about how to choose the right investment for your retirement and for your pension. We've had a lot of inquiries where people are talking about potential values in pensions, what they need to get to, what sort of income they can take from them. And when we're starting to talk to people about levels of risk and their approach to risk, we're also talking about the underlying investments and the options within their pension.
Yeah, as Matthew said there, a lot of the previous podcasters focused on taxation and sort of that point of retirement. How do we best draw down from it? And I do think a lot of value does come from that with most clients that we speak to, because it's something that's completely unfamiliar with them. But we haven't really touched so far as much on sort of how do we actually get to that point where we've got a lump sum that we're happy with, and then we're able to sort of draw from it tax efficiently. So yeah, as Matthew Wright says, today we will be talking a little bit more about sort of the underlying investment within pensions, the sort of options that you have within that, and where you might want to start look at potentially tweaking it here and there.
Go on.
I was just going to introduce Jargon Buster as usual there. I'll let you take it this time, Matthew. We're going to be looking at sequencing risk. What does that mean?
Yeah, so sequencing risk, again, I think we've mentioned it previously on the podcast in relation to risks. Essentially, that means if you're taking money from a pension or an investment on a monthly basis, if you're doing that at a time when there's market volatility and markets are falling, you've got that sequence approach where you're actually selling more of your units, selling more of your investments to pay that same amount of income, and that can actually do damage to your long-term income strategy and your value of your pension, especially if you're selling from a distressed asset. The logical thing for us to talk about when we talk about sequencing risk is how we almost look to protect against it as well.
Yeah, absolutely. I won't touch on that because I know we will speak about it a little bit later in the episode, but yeah, absolutely something that we can run through. But sort of looking at sort of investments in general and what is the right investment, again, with everything financial advice, it's inherently personal and there's no right answer. But I think at the root, it comes down to sort of understanding your goals and what you're actually wanting to achieve with your life, I suppose, and not just sort of your pensions or investment. Are you looking at sort of, do you want to create an income with the investment, which most retirees will? Do you not necessarily need an income at the moment? You may be a little bit far away from retirement, or you've maybe got other income coming in which case you might want to be more focused on growth. Or sort of what we spoke on last episode, are you more looking at the legacy planning, the sort of estate planning side of financial advice? And those three, I think, really start to put you on a path of which investment might be right for yourself.
Yeah, definitely. I mean, we were at a conference recently and we heard from a lot of fund managers, economists, and we also were in the audience with a lot of wealth managers and a lot of stockbrokers. Again, those are the sort of individuals who could talk to you for hours about why one specific stock is a better investment than another, or why one specific investment option, for example, a US fund might be better than the next. Again, what we're not going to talk about in today's episode is go into the nitty-gritty of those debates. What we're going to talk about is the high-level investment strategies, how we can mitigate risk, how we can get good value for our investment returns, and how we can essentially allow people to have the investment option behind them to enable their goals. And that's where I think a good financial planner is knitting together the actual Lego bricks and the planning elements with pensions, investments, and the underlying funds, and also then aligning that to an actual goal.
Yeah, and you mentioned risk there. It's always inherently linked to investments, and we've spoke about sort of different types of risk that can occur sort of during the financial planning journey. That might be stuff like inflation risk or interest rate risk. Today, we're very much looking at sort of the risk that's linked with the volatility of your investments, the sort of risk that they can go up or they can go down, linking it back to sequencing risk, the risk that they go down when you don't want them to, when you really need to draw from them. And more simply than that, I think you can almost break down investment risk into sort of how much you've got in assets that are going to be more volatile and are going to try and sort of really drive the performance of the portfolio compared to how much you might have in more defensive assets that might look to sort of take out some of those big peaks and troughs and give you a little bit more of a steady income. I tend to sort of like to describe risk as a risk triangle. Matthew might laugh at this one, but in the same way as you've got the fire triangle of you've got sort of heat, fuel and oxygen that you need to have fire, I see it as a bit of a risk triangle in terms of you need three different things to be able to actually take risk and go to those high levels. And I see them first as sort of the need to take risk. Mm-hmm. Do we need to grow an investment? If you've got £2 million and you only need £20,000 a year, you don't necessarily need to take any more risk. And that might be where we're more looking at capital conservation as opposed to capital growth. You then need to look at the capacity that you have to take risk. So if something was to go wrong with the investment and we were to sort of see a large dip, is that going to materially affect your day-to-day life? So the capacity to. And then the final third one, which sometimes is the most important, is the willingness to take risk, because you might need to take risk to get to a goal that you want and you might have the capacity to, but if you aren't comfortable with taking that risk and you're not comfortable with leaving those invested for the time that we need, then that puts you at risk of making potentially a bad decision and like pulling out of the market when you want. So I really see as sort of all three of them are needed to make up a risk profile. What are your thoughts on that, Matthew? Or is that a bit of an abstract concept?
No, I think that makes sense. I mean, I don't necessarily think about the triangle, but I definitely think about the three factors. I definitely think about, someone wants to have the feeling and the psychological view that they're willing to take the risk, that's brought them to the table to say, yes, I'm happy to talk about investments that can go down as well as up. Then definitely you need to have the capacity for loss. You definitely have to tolerate, that your funds could fall and that's not going to impact your standards of living. And then that final one of the need, I think that's a crucial one of it's the goal, that's the objective. If someone won the lottery and they had more money than they would ever spend, do they have a need for investment growth? Well, there's an argument that they don't. Do they have a want for investment growth? Would it be sensible? Or is it a case of, actually, maybe I won't spend this money, but I might leave it to the next generation. So therefore, there is an objective that we can, knit together for a need. So I think very much the psychological approach to how do I feel about investments and risk, and also how does my financial scenario work together with that.
Yeah, and that circles back to what we said at the very start of it. It's about understanding your goals, because equally those three different factors can be impacted by the goals. If one of your goals is that you want X amount or a certain type of lifestyle in retirement and you're only 20 or 30, you've got a much larger time horizon, therefore your capacity to take risk goes up. And to be honest, your need probably goes up as well, because you need to outperform inflation. And that's another thing that I think really impacts how you might want to invest, is how long do you have from making the investment to potentially needing to access it in the future?
Yeah, definitely. And I think, rightly, as you say there, if someone's saving into a pension and they're young, they have risk as their friend. They're paying in on a monthly basis. And therefore they've got a long time horizon, and really volatility and risk definitely their friend. Psychologically, they might be the same individual then as retirement, but at retirement, when they might stop paying in and then start to take from it, risk stops being their friend and volatility stops being their friend, and they would benefit from a different risk approach and possibly some strategies to help mitigate those risks. So again, it's really about thinking about where you are on that journey. And equally, I think sometimes people miss the fact that at the retirement isn't the end, and even passing wealth down the generations, as we've talked about at length, you could have someone who thinks they'll leave some pension or some funds to the next generation. So if their life expectancy is 20 or 30 years, actually if funds are going to be trickled down, they could be invested for 100 years. So it's about reframing and thinking about the purpose of the investment as well.
Yeah, exactly. And you've segued quite nicely onto there into what we're going to chat about just briefly next, because we have done a full episode on it, on sort of different risk profiles for different parts of your estate. Essentially, if you've got those longer term ones, you can take a high level of risk. If you do have any, when you potentially get to retirement and you want sort of a couple of years income or certain holidays and lump sum expenditure, they might be towards the lower end. And that's where something like a bucketing strategy, which we've touched on previously, where short term might be in cash, longer term might be in equities, and then medium term might be somewhere in the middle, can work quite well. And that, again, going back to the jargon buster, that's where it can help with sequencing risk, because if you've got something that you can fall back on, it allows you to keep your pension fund or whatever the higher risk asset might be invested, allow it to recover, and you're not really sort of giving your fund a big haircut at the start of retirement.
Definitely. And from a practical point of view, if someone one of our clients is taking a regular income or is approaching retirement and they're ready to take a regular income, practically we'll say 6 months of that or 12 months of that income should be sat in a low risk asset like cash. Can be within a pension, can be within the ISA, but it's essentially doing exactly what you described there. It's avoiding sequencing risk, and it's saying to that individual, if there's a market event, if there's a crash, if there's volatility, you don't have to change your plan, you don't have to worry, you can carry on taking the income that you want, and then as long as we get a bit more stability within a period like a year, you're able to top up that bucket essentially. So yeah, I think as long as you haven't got all your eggs in one basket when it comes to volatility, and even someone who is the most high risk individual, they might say, oh, well, I want 100% in the markets or 100% in even more risky investments than just equities. Even for them, if they're taking a regular income, they want to have an element of security. They want to have an element of lower risk to help them with the diversification.
Yeah, and that's where sort of it comes on to how do we manage risk. One of those things of managing risk, it might be having a different split of assets in equities to other, which we'll come on to, or more broadly, it's just about diversifying your investment. If you're solely on one specific stock and then that has a bad result, or it could completely implode, there goes your pension, there goes all your goals and objectives. If that's just one stock or one holding within 1,000, then it really reduces that sort of localized risk within that spot. So I think it would be good to, before we sort of go into that a bit more detail, just talk about different asset classes, what they are, how they work, and sort of what are their places in a portfolio.
Yeah, definitely. I think, when we think about the classic portfolios, you're looking at having equities. So they're essentially holdings in companies, the drivers of, long-term returns. You might have that broken down to be UK companies and also global companies. Anyone who's looking at any performance charts or looking at market updates in the last couple of years, there'll be a massive focus there on the US. And again, that's because we've had a lot of growth there, and there's been a lot of the Microsoft's, Amazon, Alphabet, some of the big names are all listed on the US markets. When we flip that the other way and think about not investing in the companies, but lending to companies or to countries, then we're thinking about debt. So that's bonds or gilts. And then you've also got cash, which is a low risk asset. And then adding on to that as potential option that we'll talk through, you've also got things like property, which could be commercial property. And you've also got alternatives, which could cover commodities, gold, that sort of thing.
Yeah, and I think sort of how you look at using these together is an interesting one, and it's one that there's no right answer to. And to be honest, there's one where there's very different schools of thought on sort of what best. Traditionally, most clients have heard of, or not most, some clients have heard of sort of a 60-40 portfolio. It's something that's quite common in financial advice, and that's essentially it would be holding 60% in equities and 40% in bonds.
Yeah.
And the idea behind that is generally in recent years, well, not very recent years, but recent history, bonds and equities have been negatively correlated, which essentially means when equity prices rise, bond prices will fall, and vice versa. And that gives you a little bit more of the smoothed effect, and you're not at the will of Trump's tariffs as much. The issue is that we've found over the past couple of years is that sometimes that equities and bonds are positively correlated and will move in the same direction, so both can fall at the same time. And that actually in further back in history, I'm saying like it's ages and ages ago, it's not that long ago that they were always like that, and it's only really sort of in recent years where the 2010s onwards and the early 2000s where we've had sort of low inflation where that's been the case. Now we've obviously changed into what has been sort of hyperinflation. It might change a little bit. What are your sort of general thoughts on that, Matthew?
I think what you've described perfectly there is the textbook how an investment should behave versus what might happen in the real world. So the textbook would say you invest in a portfolio, like you described, 60% equities, 40% in bonds, and that should give you positive returns, and it should also protect you because they don't behave in the same way during times of market volatility. But what you've also rightly highlighted is at times of extreme pressure or high inflation or certain market events, the financial crisis, COVID, high inflation as examples, those correlations can crack, and actually instead of having negative correlations, you can have things going in the same way. So that's why there's probably more of a school of thought now of adding additional diversification. So adding in extra exposure to commodities like gold or like oil, and then potentially even currency exposure to say, the yen might be a safe currency. Again, the dollar might be a safe haven currency. If things go volatile, those sort of tend to do well. So from a high level fund strategy point of view, you're looking at, or the fund managers are looking at, diversification across asset classes, diversification across geographies, diversification across currencies, to really try and say, if there is going to be volatility in the market, we're trying to dampen that down where possible for our clients.
Yeah, absolutely. So those, each sort of cash, bonds, equities, alternatives, they're all sort of the individual building blocks to an investment portfolio. How you put them together will depend on your level of risk, but equally you can put them together in a couple of different ways. So one way, maybe the more traditional way, would to be let's look at taking one fund that specializes in bonds. Let's look at one fund that specializes in alternatives. Let's look at one fund, I'll go on and on, that would look at sort of UK equities only, and there'd be a specialist fund manager that looks at sort of managing that, and you take all the different funds and put them together. A more modern alternative to that would be something like a multi-asset fund, where instead of having 20 different fund managers all being a specialist in their different area, you've got one fund manager that looks at it more broadly and diversifies the assets in that way.
I think with everything in this sector, lots of people will have an opinion, and a lot of people will have their view on how best to do it. That multi-asset approach that you've highlighted can be a really cost-effective way to do it, with a company sort of having that high-level structure where they can adjust the asset allocation to get the exposure that's required. As I mentioned earlier, when we were at the conference recently, there was a lot of people who would tell you, and talk to you at length on why one company is better at doing it or why one approach is better. Again, looking at risk management, looking at growth potential, looking at factors and tilts. Essentially, what we're trying to do is come up with and review all those solutions for our clients to look at the most effective way of doing it. And one thing that's changed recently is, capital gains tax allowances have been squeezed. So a multi-asset fund does a really good job of essentially doing internal transactions to change asset allocations. Whereas if you have lots of different funds within your portfolio, you might be thinking about the underlying, capital gains.
Yeah, equally, the sort of multi-asset fund, I suppose, could be partially like a set and forget if it is managed to a certain equity allocation that you want. Whereas if you are investing in individual underlying funds yourself, you might have the risk of one outperforming the others, and therefore you're actually exposing yourself to more risk or less risk than you might want.
Yeah, I think our view is also there's an element of, when there's significant assets and when you're looking at a portfolio that might be in a pension where you're not thinking about capital gains, for example, you might be then able to specialize and use those fund managers. So it's about the right investment solution for the individual. Again, it's a bit boring when we say it, that it has to be, the individual has to be looked at. It has to be the right solution for them in line with their attitude to risk and what they're looking to achieve. But as we said, broadly speaking, there can be almost off-the-shelf portfolios. There can also be lifestyle and funds that we've talked about previously, especially in relation to pensions. And that is where they're trying to, automatically adjust that asset allocation and that risk profile in line with someone's investment journey. I know you're quite passionate about lifestyle funds, so I'll let you jump in on that one.
Yeah, we'll continue the crusade on lifestyle funds, really. I think they're good for someone that hasn't necessarily looked at it in the early years, because they do push you more towards the higher end of the risk spectrum, which some people might not be as comfortable with, but if you've got 30 years, it might be the right thing for yourself. What I don't like is when you get much closer to retirement, they're a little bit old-fashioned in the fact that the majority of them are going to assume that you're going to purchase an annuity in the date that you retire, and therefore they'll start reducing down that sort of asset allocation to more defensive assets like cash, alternatives and bonds. And sometimes I've come across when clients have turned 55 and they'll come in to review their funds that are in their pension, and it's 100% in cash, and it's just going to be losing value against inflation. So I think early years they can make sense, and a lot of the time they're fine. I think it's more just about, as everything with financial advice, just be mindful of where everything is invested and know that they're not the be be all and end all. You can actually manage them in line with your own personal risk as well.
Yeah, I saw a fund recently that essentially from age 75, it was invested 100% in cash, and the cash return wasn't, cash interest rates as people see it. It was the base rate. So again, that was okay when the base rate was a bit higher, but there's times in modern history when the base rate's been, 0.25, 0.5%, when again, that's a very poor return from an investment within a pension.
Yeah, absolutely. And then do you just want to cover sort of the last type of fund that most people might come across in a pension? This is a little bit more of an older style fund, so it's more for legacy pensions.
Yeah, so the with profits fund, again, I find it sometimes it's difficult when people see this sort of investment within their paperwork without quite understanding it, because often it's quoting, it's not showing the volatility of the investment. It's quoting a terminal bonus or a market value reduction. So it's trying to smooth and take investment returns and risk out of it, but then it is still pricing that in when someone comes to withdraw the investment. So in general, I think it does a job of trying to manage the psychology of it, but I actually prefer the idea of someone understanding the risk that they're taking and actively adopting them.
Yeah, I mean, with profits funds, some people have referred to them as smoke and mirrors in the past because you don't know exactly what they are invested in. They tend to be pretty high cost as well. And yeah, as Matthew said there, in times where it's performing well, it will tend to pull back some of the profits so that when you're maybe not performing quite as well, then it can give it back and have that smoothed approach. But in my opinion, that can also be achieved through sort of proper diversification and segmenting as and where you need to your actual investment assets themselves.
Yeah, I think just so we're not fully kicking with profit funds, there are some modern with profit funds that are a bit more cost effective and they can do a really good job. But I think they're really useful for the low risk investor that doesn't want to feel the loss or see the loss, and they'd rather know that some of the money that's been held back from the good times can be used for the volatile times. So it does work there. But I would say for the majority of people who are thinking about investments, who are looking at this sort of video and thinking about long-term returns, they've probably got an understanding of risk, an appetite. If you take it back to your triangle, they've probably got reasons why they want to take risk rather than be smoothed.
Yeah. Okay, and then moving on to, I suppose, one of the biggest debates of our time from investments.
Who was the best England manager?
No, there's always people that will be, I suppose, quite passionate on either side of this debate of active versus passive investments. Maybe, actually, to be honest, the average person probably doesn't care whether it's active or passive. But within the industry, people will be pretty strictly whether they prefer active or passive investments. And I suppose just to sort of give a sort of a base understanding of what that is. A passive investment or a passive fund that you can invest in, generally there's no input from the fund manager on a regular basis. They may set up what the fund should invest in, so it might be investing in a US index, so track the stock S&P 500, and it would try and mimic that to get you the returns of the fund, and you essentially see it as the markets will be what the markets will be. Let's have that return. And an active fund is a little bit different in the fact that you've got a fund manager there that's tried to make active bets on individual companies within that index or within that basket of funds that you could invest in, with the intention of sort of outperforming the market. And active management, because there's more research, there's more people involved, tends to be a little bit more expensive than passive funds.
Yeah, definitely. I think I've had a few people who've been on the phone off the back of the podcast, and they've had an assumption that as financial advisors, we're always going to prefer the active approach because potentially it's more expensive, or potentially there's other financial advisors out there who have got their own in-house active portfolios. So I think, from our point of view, we should very much highlight that we're quite agnostic in relation to active versus passive, and we would prefer to be able to use the Lego bricks in the right place. So one of the things I often highlight is in the US, for example, there's a lot of information and a lot of data out there. So passive approaches, which are very cheap, can actually do quite well because tracking the market can get you to where you want to be. But if you're looking at something like a UK smaller company sector, where there's a lot less information and it's a lot more about, fund managers or fund management groups meeting with CEOs and finance directors and understanding what's going on beneath the company, there's a lot more value add that they can do. So I think from a high level point of view, we like a bit of both. But I think you will have some people who are very passionate about low cost is the right way to go. And obviously that comes towards that sort of passive approach. And in the current environment where the US has driven a lot of market returns, we're probably at a point when the passive approach might be winning the debate, but equally during a time of market volatility and when things fall, if that passive fund is just tracking an index down, that's when a fund manager or a fund management group can stand up and say, look at our active decisions and look how we've managed risk accordingly. So there's never going to be a winner in the debate because of the snapshots of which bit of history we're looking at.
Yeah, and I suppose with passive funds as well, although they do track the market, they don't always, a lot of the time due to fees and timing of transactions, they won't actually get exactly what the index is, and they'll generally have set rebalances that might happen monthly or quarterly, and they pay no attention to announcements like Trump's tariffs. So that's where something like an active manager could look at being a little bit more defensive during those times. But I mean, some outperform, some don't. It's not often that you'll find an active manager that will always outperform, which I suppose is a hard thing when you're looking at fund choice.
And I think that's where, if we throw a cat amongst the pigeons, you can't have an active passive approach. Again, you can have an active asset allocation, and you can have a tactical approach that we quite like to say, well, where in the world should we be invested? But equally, those Lego bricks, the underlying bits could be achieved with the low cost approaches. So I think that's where, taking it back all the way to the objectives and what someone's looking to do, we can build a portfolio that's in line with someone's level of risk, that's got a real focus on track record on performance, but also has a real track record on keeping those costs down, because I can already see someone in the comments saying, well, cost is the only thing that we know that's guaranteed. So if we can minimize that, then we get the best potential chances of return. And they're right. But equally, there is some sectors when the low cost option doesn't really unlock all the information. And a colleague had said to me in the past, you don't buy the cheapest parachute. And I think, again, that can really work in this active versus passive debate in certain sectors. So as well as thinking about what's beneath the bonnet of the underlying investment, we also want to think about the tax implications of the wrappers in which it's invested in. So again, I mentioned earlier about a common investment strategy and thinking about the right level of risk for the individual, but there can also be an argument for taking more of that risk budget within a certain product because of its tax efficient location. So for example, an ISA, you get no capital gains tax on any growth within the ISA, and you don't get any capital gains tax within a pension, but you might then be paying income tax on the money coming out. So if you're looking at that and you're thinking about a personal portfolio, a pension and ISA, it's just being aware of the wrappers and the considerations of the tax to then say, if I want to take risk to potentially produce more returns, I want to do that in the right home, essentially.
Yeah, absolutely. I mean, as you say, don't let the tax tail wag the investment dog.
Stealing my line.
Common saying, but just do the simple things right. Just reassess where you're holding certain things. As Matthew said, if you've got cash in an ISA and you may have investment funds outside of a tax efficient wrapper, just reassess. Could you maybe move them to be a little bit more tax efficient in one way or another?
Definitely. And I think that's certainly where, financial advice and planning can come into it. Again, banks were really good at selling cash ISAs, but actually could that ISA have been better used with a stocks and shares ISA where the engine of growth was, had the potential for someone to grow and grow and grow. Again, we've seen in the news people being ISA millionaires, and that's that perfect element of having the right investment in the right tax location and then continuing to use their annual allowances.
Yeah, I mean, and some people obviously recently have seen with regards to budget rumours, which inevitably start around this time in the year with the budget coming up in autumn, although it's now 26th of November, which I think is one of the latest budgets that there has been. There's been rumours that you could potentially reduce down the cash ISA limit from £20,000 to £5,000. Again, that might push more people to look at the stocks and shares element. Whether that's the right way to do that, we'll leave for another episode. But I think it's an interesting one. And actually, just thinking off the top of my head there, at the moment, you can obviously transfer between stocks and shares ISAs and cash ISAs, no problem. They're sort of two of the same.
Yeah.
it would be interesting to see how they'd have to implement that if they were to reduce one ISA to the other.
Yeah, I think a bit like the British ISA that was announced and then never happened. Again, it's the idea that they probably want more people investing in companies, but then the logistics of how they do that, again, investments on the FTSE 100 might have 62% of their earnings from overseas income. So again, how do you really get people to invest in British companies by having that sort of idea that, again, we know didn't happen? So I think there'd be a lot of thought process behind it. But actually, if the end result was people couldn't put as much into cash ISAs, but they could still put the same £20,000 into an investment ISA, I don't think that would be the end of the world. Again, it all comes down to people's view on risk and what they're looking to achieve. And a low risk individual who says, I'd rather only hold cash, they could still find an investment option that worked for them.
Yeah, and rounding off sort of the episode, as we always really do, look at sort of the behavioural factors and the psychology of investing, not just the technical points. I think it's interesting, and it comes down to sort of, are you comfortable managing that on your own, or is it the help of an advisor that would help you through them? I mean, I can think of a number of times where we might have had clients that have come to us during a market downturn and they need that sort of reassurance to ensure that they are on track with that long-term plan. And I think that really is part of it, making sure that you have that long-term plan so that you can fall back on that when things might not be going quite to plan, if that makes sense.
Yeah, we recently heard from a behavioural psychologist at that recent conference. And again, she was really interested with what she had to say, in the sense of everyone comes to the table with baggage from previous experiences or what they've been told or what their parents have done. So again, thinking about anyone who's had a failed endowment mortgage, or someone who's seen Northern Rock have issues, or someone who's had an issue where they've dealt with a financial advisor, but the fees might have been high and the service might have been poor. So it was really interesting to see her views on how financial advisors can help people to, one, unpick some of their previous biases that might not be correct, but equally how we can help people to, get comfortable with a long-term plan. And, what do we see a lot? We see market volatility, but that's sort of normal. And because we've seen it more than a client who might have had, suddenly have an investment off the back of an inheritance, a divorce, or a retirement or something like that. So again, we need to help people with the journey of getting used to investments, understanding them, and then knowing that volatility is okay because we've got a plan that's going to last their life expectancy. I've told the story before where one of my clients rings up every so often during a time of market volatility, mainly because they just want me to say it. They just want the reassurance. And certainly with the Trump volatility most recently, she rang up and said, can I have 5-10 minutes? I know what you're going to say, but I just need to, it needs to come out of your mouth. So again, for her, there's nothing to change because we've got a long-term plan. We've got a cash buffer. We've got the income to be sustainable. But this might be the first bit of market volatility where she's felt a bit uncomfortable. So having that conversation is ultimately the right thing for her to do.
Yeah, and I think that sort of interaction is one of the really hard things to almost quantify the value of, because there's been no sort of transaction made. In fact, we've actually stopped a transaction potentially happening that might have been to the detriment of the client. And it's quite hard. There's various different studies out there that look at sort of how an advisor adds, and it might be straying a little bit into behavioural coaching as opposed to strict financial advice, where if you're looking at tax efficiency or investment performance, it's much easier to quantify. But there's, Vanguard Advisor Alpha is one that looks at that. If you're interested, you can have a look at that yourself, and that tries to break down sort of the impact of potentially making bad decisions, making sure that everything's rebalanced properly. But I suppose it boils down to me the value of financial advice, and I won't go on. I probably could go on all day about the value of financial advice, but I think it's all about making sure that you're not doing those costly mistakes just as much as sort of the additional bit of investment and tax efficiency that you can actually add that's maybe more known in financial advice of the value.
Yeah, and I think if we jump back to a couple of the stories I've had from this episode, the pension plan that automatically went into cash and followed the base rate from 75, again, from a pure investment decision, that was having a return that was a lot lower than what the market was offering. So, with a financial advisor involved then, that would have been the first thing that we would have said, oh, let's change this. Again, that same, similar example where a death benefit was automatically paid out because that was the only option within a pension, again, that's a really good time where a financial advisor would say straight away, actually, there's been a change. There's a new modern pension or there's a new modern death benefit that can be bolted on. Let's change that. And actually, that will save tax and investment performance. So I think that's where I can see the other school of thought who says if a financial advisor charges on average, say, 1%, that's going to be eaten into my wealth. But actually, the bit that's harder to quantify in response is to say, actually, think about the tax relief, think about the investment performance, think about the challenge in your view and perception to things to actually add a lot of value, both in terms of returns and tax savings, but also the psychological bit of being invested.
Yeah, I couldn't agree more. I mean, I realise we're running a little bit long on this episode, so we'll almost park that psychological side of things and maybe explore it in a future one. But jumping on to the listener's question, it's one that we get quite often in initial meetings. If it's someone that hasn't had advice before, and it's someone that's approaching retirement, do I need to change my investment within my portfolio or pension now that I'm retired and looking at taking an income?
And I think, it's a very common question. I think it probably has two different answers. If it's someone who you're just talking to in that moment to then help them with the retirement, you might say yes, because you want to pick up that idea of what level of risk do you want to take, what you're looking to do, and it's about the long-term thinking. But if you've already been talking to that individual and you've built a long-term plan, you've probably already done the heavy lifting to say, this is an appropriate level of risk that's right for you for the long term, in line with your needs, your objectives, your capital, all your capacity for loss. That's thinking about it. So there might be tweaks. So like we mentioned before, with the bucketing and almost having a pot that you might draw down on in retirement, there might be those minor tweaks. Now you are actually going to access funds and there is going to be the logistics of it. But my high level answer would be, we've built a plan for the long term, and retirement might be a massive life event and the client might feel that they right to ask the question, but most of the time the answer is, no, this is all factored in.
Yeah, exactly. It's not necessarily a need to change it at retirement, although if you haven't already, it's probably a good trigger to look at it.
Exactly.
And as you said, although you are retiring and you might want to access some of the retirement fund, the vast majority you're not going to be accessing for a long time, sometimes maybe sort of 30 plus years, depending on sort of the length of your retirement. And to summarize sort of that, and I suppose the full episode, it all just boils down to what your objectives are, make sure that it's sort of invested in line with those and working towards those goals at sort of all times. And if not, maybe that's a point when we should look at changing it.
Definitely, couldn't agree anymore.
Okay. Thank you very much for watching the episode. As always, feel free to comment down below if there are any questions, particularly if there's anything that we've discussed today that you may disagree with. It's always nice to have a little bit of a debate. But if not, please like and subscribe, and we'll be back next week, for another episode. See you then. Thank you.